So just to introduce myself, my name is Brian Phillips. I'm the CEO and co-founder of Argosy Global Advisors. We're a risk management firm here based in New York. And before we get started, I'm going to let the panelists introduce themselves. And if we can start with Alex here, we can get started.
Okay, does this work? Yeah, okay. Hello everybody, my name's Alex Knight. I work for Citi. I'm based in Singapore, but here for the week. I started Citi's FX Prime brokerage business in Asia in 2007 and have run that business since then, during which time we've onboarded many of the larger broker clients in the region. And I'm also involved in our margin trading business, which allows us to look at the tier of brokers that sit maybe slightly beneath the conventional FX Prime brokerage market. So that's really what I look after.
Here we go. Now it's working. My name is Emil Assentato. I started FXDD in 2002 with the parent group called Tradition, which is a Swiss company in the IDB world. Back in 2007, we moved Tradition shareholders to some individual investors, and Tradition is still a minority partner in our firm. We have about 120 people working worldwide for FXDD, and retail is our expertise, hopefully, and that's why we're here.
Yeah, thanks for sticking around. Appreciate it. Phil Harris. I look after strategy for FX at NASDAQ out of New York. And this is my 27th year of being at work in the financial services industry. And, happy to be a part of the conversation. The association of FX and NASDAQ is probably something new to a lot of people in the room. But that's why we've decided to team up with Shift, and that we have hopefully a lot to contribute to the industry, all in a positive sense. So we're happy to be here and be part of the conversation.
Hi everyone, Vatsa Narasimha. I head up strategy and corporate development for Oanda. I've been with Oanda about 9 months now, and before that I was with the Boston Consulting Group, primarily serving capital markets firms across the entire spectrum. Retail FX is what I live and breathe right now, so if all of you can take out your iPhones, download the Oanda app and make one trade, it'll actually increase the market volatility right about now.
Thank you very much, guys. So to get started, obviously we spent a lot of time today talking about different ways that every business is trying to grow, and that's one of the things we wanted to start off talking about today. In each of your businesses, obviously volatility is a key part of why people aren't making more money than they are today. So despite volatility, we won't talk about that at the moment because we're all waiting for that thing to explode. We're all looking at the charts, waiting for that thing to change. Despite volatility, where do you guys think, and if we could start with Alex, what do you think are going to be some of the key things in your market to help drive volumes? And is that specifically to new markets, new technology, client acquisitions? What types of things do you think are going to help the industry in terms of growing volumes in the next 6 months to a year?
Gosh.
I took the easy answer off the table.
Yeah, thank
volatility,
you. Yeah.
Maybe he has the answer.
Yes, that's right. So I think as I look at my customer base and I sort of see what people are doing, who's winning, who's losing, where the new volumes are coming from, clearly the new externalization of flow, or the emerging externalization of flow out of China, is something that is making a big difference for those that can participate in that Chinese market, those that can get close to the Chinese market. There are opportunities. For many people, it's not possible. You have to take it sort of on an arm's length basis. For those that can get close, there is incremental volume to be had, and I think there's incremental volume, therefore, to be exposed to the global industry. You could say the same of perhaps some of the flow in India as well, where people, again, are starting to externalize flow. Stuff that's been bottled up really within the confines of India is now starting to sneak out. Those two things, I think, are opportunities to add incremental flow to the global business. Other than that, I'm not sure I see any obvious avenues right now, I'm afraid.
No, that's fair. Emil.
Well, if you purely talk about retail, the answers are, as Alex just explained, China's opening up more and more, and India is becoming a place to participate in. But I think what we're seeing also is there's a globalization, a merger of institutional FX and retail FX. They're getting closer together. And we're going to see more and more retail look like institutional, and institutional dip more into the retail space. And we'll get a consolidation through that process. So does that answer the question, do we have increased volumes? Without volatility, I know that's sort of prohibitive right now in this conversation, but without volatility moving out, we're going to have a very tough time seeing volumes grow.
So from the NASDAQ perspective, we are, mostly known for our equities complex, and our kind of public ambitions are to diversify our franchise into the FIC model, fixed income currencies commodities. We've aligned our kind of teams to reflect that of our customers, and we want to build out and be active in those market segments which are new to us. And when we look at FX, we see a lot of our customers that are very active in the FX market, but are also very active in our index or in our equity options complex. And so we share mutual client relationships, but we don't have an FX business, so to speak, so that we can't monetize their activity in another marketplace or another vertical. But they understand how an exchange works, very comfortable with how exchanges and clearing works together. And so we see a wonderful opportunity to kind of step up and create a venue that would enable growth from a very diverse customer segment. So I wouldn't just say, we have some pretty neat things that we want to do in retail, but we also have some pretty neat things that we want to do to facilitate both corporate and real money flow too, both in trading and matching, capacity. But from the panel this morning, there were some wonderful things that were said by some incredibly smart people, and I think that there are drivers at work today which are not just about price formation and price distribution. These are, big shifts in the cost of capital that backs up the system, and these things are gonna not drive all 100% of the flow to an exchange, but it kind of makes a more compelling reason to have another alternative. So those things we look at on a daily basis. We bring our customer base, which is already very active with us, that have gone into equity options, and their customers are looking at futures, foreign exchange, commodities, and so what. So we're going to step up and hopefully serve those with more product.
Thank you.
Yeah, so I'd second what people have talked about. China is definitely a place where new traders are coming into. The other perspective that we at Oanda are taking are traditionally sort of your FX traders are, it's a small group of people, and then if you look at it from a global perspective, you can add maybe sort of CFDs or metals or commodities traders in there. But we are also taking the approach of how do we bring passive investors and truly get them thinking FX is an investment class. So we made an acquisition late last year around the copy trading system, but it's really truly we're thinking about it as an investment vehicle. And do I believe that in the next 6 months that'll add volatility or increase volumes in a dramatic fashion? No, but it's also redefining what FX means to people. So it's not just people who are used to day trading FX, have multiple screens across and are sitting and doing it, but it's instead how do we think about it as a legitimate investment asset class, and how do we bring retail traders who are investing in a lot of other things, how do we get them to think of FX as a legitimate vehicle?
Thank you, Vatsal. Vatsal, you mentioned CFDs. Yeah. I just wanted to ask the panel here about, where do you see that as part of your value chain and growing your volume? Obviously, you can go into different parts of the market. So we talked about China and India, and you can grow your core customer base that way. But for those of you who offer CFDs, and for those of you who don't, do you see that as another way to generate volume and revenue going forward? Is that going to be a valuable part of the retail offering? And how do you see that in the next 6 months to a year for your firm in the industry?
Yeah, so we offer CFDs. Obviously, you can only offer it in certain geographies, but we offer it in largely in Europe and Asia, and we are seeing it already. Our existing customer base itself is starting to migrate a little bit of their volume because they do have the need to trade, and CFDs underlying their algorithms still tend to work, so they're trying it out. So we are seeing a volume shift, but I don't know if it will offset, if you want to use your benchmark as first half of last year in terms of what volumes people were seeing. Will all of that come back with CFDs in the next 6 months? If it does, there'll be no one happier than me, but I don't think so.
That's fair. Alex, in terms of,
I mean, you know, when I look at my customer base, obviously those that have CFDs have had a great hedge, you know, for the last sort of fairly miserable 8 or 9 months. Those that haven't have suffered more pain. I guess I have maybe a question, and I should probably know the answer to this, but I don't. In terms of yield, how does CFDs compare with regular FX?
it's a bit higher, considerably.
Yeah.
And that's what we're starting to see brokers who haven't offered it looking for pricing sources. And there's not a lot of available pricing sources. You have to either build it from an exchange yourself or look to, you know, share it with one of your competitors or do something creative.
And so I guess the follow-up question to that then is the yield going to compress as dramatically as it has done in FX?
That's a good question. And that actually is, you know, we can take that and go somewhere else with it and say, as you guys have seen volumes stagnate in this low vol environment, have your clients been taking less risk and kind of sending more flow to you in terms of an STP perspective? And do you think as volumes increase or vol continues to move, when it moves higher, are you going to see that switch back, or are you seeing, you know, where do you see your clients taking risk? Is it moving away from risk, or is it moving away from taking more risk in this environment?
Actually, I'd like to say something about Phil's initiatives with the NASDAQ on foreign exchange. Historically, as exchange products come out, the OTC markets react positively to it. So we may get extra volume through the exchange products that Phil is trying to roll out. Hopefully we will. We've seen that for the last 30 years. Exchange products drive more OTC products, and as long as the regulators allow us to still be OTC, that'll be a good thing. So Phil could be a real positive, Phil's initiatives could be real positive to the retail FX market in terms of these volumes.
I completely agree. I mean, I'm not going to disagree to anything you said. You know, there's the 800-pound gorilla fear, right? That exchanges come in and just mess up the marketplace. But you know, we've seen other exchanges offer complementary products, right? So you give, I think, you know, we think about FX more broadly as a portfolio, right? And you see the banks that are prime brokers and FCMs have, you know, Citi is a great example of this, right? They run a really fantastic prime brokerage business that they see a client on a listed venue and on an OTC venue, and there's one point of contact, and that credit is extended into listed and OTC venues. So we want to be that way on the other side of the fence. You know, we want to be a venue and a CCP that can then mimic that, so that we'll have a mix of both listed and OTC instruments, and then allow the customer to make their choice on how they want to interact with whatever liquidity is present. So that's an enabler, I think, for growth.
Thank you, Phil. One of the common threads when we were talking about the exchange this morning on the different panels was the need for, like, we want an exchange because we're going to have better price transparency, better price discovery. Are there other parts of having an exchange besides price transparency that would be additive to the retail space?
I mean, in one sense, there's you know, the ability to do all the things that were, you know, kind of referenced this morning about more transparency on price formation, you know, standardized stop loss activity, perhaps a larger concentration of market makers and participants that you are not trading with the house, right? So the house is facilitating the venue that allows for a more diverse, you know, community to come into place. And then there's a lot of scale that an exchange would have, right? So you can use the same infrastructure, the same plumbing, the same reporting, the same clearing. And then, you know, when you bring multiple asset classes into a single clearinghouse, you get margin relief. You know, there's a lot of things that exchanges can do, but I think what we want to be conscious of is that, you know, we are not necessarily you know, wanting to own the match, right? We're happy for the venues here to distribute product and be in charge of that distribution, and then we can just kind of step in and fulfill whatever part of the life cycle of a transaction that they're asking us to do.
How do you see yourself interacting with some of the index products? I mean, we talked about CFDs overseas. Does your platform give U.S. brokers or different brokers better liquidity, more access to different products?
Yeah, I mean, I can't talk about CFDs. We don't have them. We have no plans to operate them. But what I'd like to think is that I think we run something like 40,000 different index products at NASDAQ. That's an incredible number. We want to create product that enables our partners that set up here to be able to put together you know, interesting products. There's a firm in California called Motif that allow you to create bespoke baskets of stocks. And so I think there's a lot of, you know, technology is a wonderful thing that you can customize your own index, let's say. And there's no reason why technology couldn't allow you to create your own index that you own and that you've created. But, you know, we're very early to that, so it would be unfair to say that we've got things cooking in the kitchen, because we do not. But we're definitely having a good look at the area.
I'll ask you to answer this question last, Phil. What's the timeline, do you think, if we were able to merge and have a more exchange-based model in the retail space? Is that something that you guys see, something in the next year, in 3 years, 5 years? How close are we to having something, you know, a bigger partnership with Phil? I mean, please answer that last, and we'll go there.
Well, Phil hopes it'll be a big partnership, I think. But I think it'll be geographically oriented. You know, the U.S. will be probably, U.S. and Europe be first to it. There'll still be, it's probably a 2 to 4 year period, I think, that more exchange will bite into the OTC markets. But then there'll be a whole OTC generation of products out there that'll still remain off exchange. Yeah. In the Far East, for instance, that would be very ripe to keep OTC going. A lot of different venues out there really can't put it in exchange that simply. So I think it's something that will evolve 3 to 4 years out. It'll be a partnership eventually between the OTC products and the exchange products.
I'd agree with that timeline, 2 to 4, 3 to 5 years. And I also don't think we can say it's FX but it's a lot of instruments in there, and it all depends on what can you move based on what liquidity into sort of an exchange. And some of it will, just based on the nature of sort of how sparsely traded they are, any of that stuff, OTC or bespoke contracts might make more sense for them. So I think there's no global average in this. It has to be sort of a very de-averaged approach, both across instruments and across geography. But I think there is sort of a secular movement towards sort of getting us there. And my buddy Phil would obviously want that to be bigger than anything else. So
I think the exchange model has some challenges. You know, clearly they have some benefits. Cross-margining is a very helpful thing for the investor and trader. But the cost sector is a problem for the exchanges. Doing trades on exchange is much more expensive than doing through the OTC model. That's going to be a major hurdle, particularly the very cost-sensitive traders we have in our space now. I don't see where the exchange is going to get over that. Probably regulation is going to help exchanges pivot into certain areas like the US, maybe Europe, but where the individual or the small institution is very concerned about what it costs to do a trade, they're going to have a tough time getting over that hump, the exchanges.
Yeah, I don't want to predict timelines, because every single timeline I've ever predicted has been way off in personal life as well as business life. So what I would say is that our conversations haven't even really reached Asia. Our work is just been the US and Europe, and believe me, we're not a large team. There's not 100 people that do FX at NASDAQ. There's a handful of us. And the workload that we have for just the Europe and the US businesses, that's enough for us to bite off right now.
Excellent, thank you. Switching gears a little bit here from a regulatory perspective, which is not everyone's favorite topic, but we're starting to see some large brokers that are regulated in some pretty in top tier markets open up less regulated and start to get into less regulated markets. Vats, if you could start, is that just a way to access more clients? Is that just are we getting pushed out, and some of these big brokers getting pushed out in the markets that are participating in? Why do you think that's happening in the space today?
Part of it is in some of the bigger and more established geographies. I suspect it's the cost of doing business. So cost of doing business in the US from a retail FX space, there's a huge regulatory capital that you need to put up. And in an unregulated or or more thinly regulated geography, the cost of doing business is probably easier. But some of that, I actually have an open question on that too, because we tend to participate, we as Oanda, that is, we only participate in markets where we are sort of regulated. So we are regulated in 6 different geographies, and it's always interesting conversations having with each different sets of regulators and trying to get them all speaking a common language. But I'm still struggling with that piece of it myself. So.
Excellent. Are you seeing that, any trends develop there, or is that?
Yeah, so we're seeing, I see a lot of the Japanese brokers, or some of the Japanese brokers now opening up shops in Australia and Hong Kong, in the UK. You know, for them, I guess it's a fairly obvious play. The Japanese regulations are pretty constraining. They can't offer decent leverage. They can't use their customer funds, you know, to stock up as collateral. So it's an obvious move for them. And they do have very sophisticated and very high quality price feeds that they're getting in. So I think it makes a lot of sense for those guys to do that. They do operate in a pretty difficult environment. I think, you know, the other thing is that I find fascinating is seeing the brokers that are unregulated in Japan, you know, clearly trying to take some Japanese business away by offering higher leverage and so on and so forth.
And it's also interesting how the regulators are trying to combat that, right? Like there's this whole thing of Japanese regulators sort of saying that they're going to go talk to ASIC to say, hey, stop doing this, or at least start to try to put pressure. Now, if that ever sort of materializes, it puts a lot of people who sort of, you may call them on the JFSA's blacklist, for example. Like it makes their life, it's interesting. I honestly don't know how it'll play out. I honestly don't know what ASIC has to gain by agreeing to everything sort of Japanese regulators are saying. But it's interesting to see how some of that dynamic will play out in the next couple of years.
Would you say that's one of the probably the bigger issues if that happens in terms of those in that specific market with the Japanese and Australia and New Zealand? Is that one of the areas where things are getting abused the most in terms of lack of communication?
I don't know if I'd go as far as to say abused. I mean, it's like you're regulated. People are regulated in geographies that they're regulated, and if clients come to them, clients come to them. It could be, but Australia itself is a booming market, and then who knows what happens with China, how regulations shape up there. So there's so many moving parts in Asia. It's good to be there. I recently spent a week in Japan myself. It's very different dynamics. The retail market there is just talking to customers there. It's a very different touch and feel than talking to the US market. But I don't know if the interaction of Japanese regulator with ASIC is the biggest challenge. I don't think that is, or the biggest market movement. I don't think so.
Thank you. Emil, you mentioned before that you're seeing more crossover in the institutional space to the retail space. I know we had conversations earlier today again about liquidity providers and more non-bank LPs getting involved in the retail space. Is that something that you guys consider to be a healthy thing? I mean, how much tighter can your spreads get? Is that something that's going to continue to help you become more competitive? And do you think that one of the strategies to getting more business is spread tightening, or are there other strategies to get more business? I know in my former career at a bank providing pricing, I watched the last 2 years yield numbers continually shrink, and then that gets passed along to the broker, and then you guys tighten, and then your clients tighten. Are we at a place where things are as low as they can go? And how do you see non-banks and LPs providing value in that space?
God, I hope we've seen as low as they can go. But I think it'll probably tighten some more over the years. Just that's a natural evolution of all the products we work in, whether it's equities, fixed income, foreign exchange. They all tend to tighten over the years. What will happen probably, there'll be more liquidity providers from non-bank sources. Some of them are toxic in nature, so they're difficult to capture. What you need to provide over the time is the surety of execution to your clients, tight spreads, and those spreads will get tighter. And I think over time, institutional and retail will look virtually the same. It's really going in that direction. We're not too far from it at this point, since we have so many different players as customers now. We have guys with $100, we have guys with $100 million. You know, it just keeps expanding, and the universe expands for those types of products that offer the liquidity that we show our customers on a day-to-day, minute-by-minute basis.
Alex, how do you see that in your business?
I think there has been a crossover between retail and institutional. I think there's almost no difference between the two markets now, and you will know from your previous role that it's the retail brokers that probably receive the most aggressive pricing of any customer that any bank prices. And when that's aggregated, and aggregated very aggressively in many cases, you do end up with absolutely fantastic prices, you know, from a retail perspective. Retail customers are trading at prices that are tighter than, you know, most decent corporates are trading. Now, they don't have settlement issues, they don't have credit line exposure, and so on and so forth. So maybe there's a reason why they're trading at tighter, you know, tighter spreads, and they don't have a, you know, customer service person, and so on and so forth. But I mean, there has, to my mind, this sort of merger has effectively happened already. There's been this huge democratization of FX. I think it's pretty much done.
Probably most people in this room don't remember retail FX 15, 20 years ago. Spreads were 20 pips, 30 pips wide, really very hard to execute, no surety of execution, no formal margining processes and things like that. So the industry has gone through a massive change, and it's only benefited the customers. And as it benefits the customers, we get more customers involved in it. So I feel relatively certain that Alex is absolutely correct. There has been a crossover, institutional and retail. It's hard to see the difference. You know, and in fact, retail platforms nowadays provide the sort of size of execution at a price that many times the banks can't provide.
Yep.
And that's unique now. That's unique.
Yeah, I'd agree, particularly at the high end of sort of the trading volume and level of sophistication. A lot of it over the last few years, at least that's my exposure into the retail FX market. For the last few years, increasingly what we're seeing is automated trading strategies and more sophisticated algorithms starting to come into play. So people are moving away. So I guess the example I use is always myself. If you look at my FX trading account, it's not worth looking at, right? Like like occasional trades. Sometimes I get fascinated by the Swedish krona and I decide to go place a trade on that. That's not what most sophisticated retail traders are doing. They are taking algorithmic approach, automated trading strategies. A lot of them are very sophisticated about back testing their algorithms. I can't tell you how many Oanda clients there are that run parallel approaches in their demo account and then in their live trading account. It's almost like, you know, as we think about pushing out new versions of software, we'll push it out onto our test platform, our demo platform, and our live platform. And a lot of our clients, their strategies, that's what they're doing. They're pushing it out onto their demo account, seeing how it performs, and then moving it out onto their live account. So people are getting very sophisticated at the top end. And that's where I see the blending over or the bleeding happening with the high end, particularly some of the volumes that they're seeing. And then in Japan specifically, where the average retail trader trades almost like 5 times anywhere else in the world, those volumes with automated strategies, how do you distinguish that with institutional?
One of the other things I'd just like to add is you know, where there's a little bit of a risk, this sort of liquidity mirage that sometimes is spoken about. You know, the further away you get from the ultimate price provider, then, you know, the more risk there is that the liquidity and pricing you see is not representative of the market and indeed can disappear in a flash. And I suppose where we do have situations where we have, you know, brokers who have genuine interbank relationships, you know, who are providing prices to other brokers, to other brokers, to other brokers, and everything's propagating out, you know, many, many times. That can lead, I think, to issues, and I'm sort of concerned that the value of the flow that the banks see is pretty poor. You know, it's not pleasant flow that comes through that way. There has been a process in the banking industry where banks have acted sometimes irrationally in order to sort of win survey votes and so on and so forth. I think that era is probably drawing to a close. So I think it's probably reasonable to expect that banks will price more rationally going forward. And that may lead to, in fact, even some widening of prices. And it'll be interesting to see how the customer segment reacts to that. Will the brokers be confident enough to widen the prices that the customers see? In Japan, they went through a process of that middle of last year. They had to. You know, vols were high, prices were wide, Euromoney voting was finished. So the prices were widened out to the customers. The customers did accept it. It was fine. You know, maybe you had a bit of an impact on volumes, but you know, the only other route if the underlying spreads from the providers widen is that brokers start to internalize more and more, take on more risk, and I'm not sure that any of us feel particularly comfortable about that as an outcome.
Yeah, I mean, I'd make an observation that on our travels, we find a healthy number of non-bank market makers that are very active with large broker-dealers around the equity and equity option complex, that they might see their flow via our exchange on the equity option side, but those same group of customers are having to sign different paperwork with another legal entity that's an FX platform, where they don't have the ability to interact with those same customers because they're not allowed in the pool. There are some rules, choices, whatever stops them from getting in. And we see a healthy, you know, an appetite for more market share. They want to own a larger percentage of the FX volumes that are being transacted. And so that imbalance of supply and demand will effectively bring tighter prices to the community. So the end user's only going to have a better experience in terms of the spread. And you know, the constant battle on equilibrium, even on some of the larger, more institutional platforms, have seen pendulum swings of heavy market share owned by banks, tipping to buy side and then finding some equilibrium. I don't think that has settled, given the appetite that I see in my world of those, you know, same users wanting to come in and become larger and more dominant in FX.
That makes sense. One of the trends that we've been seeing among the retail brokers as spreads go to zero is that another strategy to attain business is now offering more aggressive rebates, more aggressive profit share deals. And I've been hearing that that's starting to become a disruptive force and becomes a little bit of a barrier for some brokers. How do you guys see that as changing your business? Is that sustainable? Is that model sustainable for those types of deals? Or are we going to continue to see that develop as in this environment as long as spreads stay where they are? Alice?
I don't have anything to say on that before.
It's very difficult to identify where the balance is. These things go in cycles, and right now the cycle is to push harder and harder to get bigger rebates for brokers and things like that. I think that will end. It'll probably end through the process of consolidation and several brokers not being, or RFEDs or whatever you wish to call them, not being able to make money in this market, given the lack of volatility as well as the appetite for more rebates to the customers. So it's not going to go on forever, but it's very painful right now.
It seems like.
Yeah, I agree. I actually think it's already starting to have an effect with volatility and volumes being as low as it's been. So there's no volume, your spreads are going down, and you're giving rebates on top of that. It's impossible to be profitable. So consolidation invariably has to happen in the industry, and then things will start to, but you're starting to see consolidation already starting to happen. So.
Consolidation from your client side or from where you get, how do you see that? When you say consolidation, in which tier of the market do you see that happening?
So my only perspective I have is on the retail broker side. And so if you look at most markets, and you saw that happen in Japan, it's slowly starting to happen in the US and other markets, just the number of retail brokers that there are, it'll start to shrink, and you'll start to see it consolidating among the top few players in most markets.
Excellent. I think we have a few minutes left for questions if anyone has them in the audience. All right, excellent. There's a question down there.
If volatility returns, which it surely will,
We all hope that.
it always happens.
Yes, that's true.
Will that consolidation trend be halted, particularly as new markets open up? You talked about China, there's an increasing number of brokers there, other parts of East Asia, Indonesia, and so forth. Are you confident that consolidation?
So I don't know if everyone could hear that. The question is, if and when volatility does come back, will the consolidation trend be halted? My personal view, yes and no. So it will be halted, I think, in sort of emerging markets, sort of whatever you want to classify as the Wild West of Forex. I think there you'll have more local players. And it always, I think, works that way, right? Like you pick a new market, you probably have a few local or regional players who have an idea of how to sell and market in that particular geography. So they will thrive there. But eventually, given if regulations, given global capital requirements, the cost of being in this business, a global scale is something that will eventually dominate out, is my personal 2 cents view.
Yeah, and I'd add that I think those that will survive and prosper are those that look to add new products into their distribution. I mean, these guys have huge customer numbers. I mean, they're tens of thousands, 100,000. I've got no idea. I just know that this marketplace is huge, and they have, pretty stable, pretty well-educated customers that are hungry for more product. And so this is where the partnership aspect comes in and makes a lot of sense, in that I can be the creator of product and then use these guys in partnerships to distribute my set of products into their customer base. And the only nuance would be it's more of a spread-based income revenue that it used to be, becomes a fee-based and less of a spread-based. But that's also a good kind of portfolio or diversification for their own revenue, given that, in low volatility, if there are still customers trading, then there are these kind of revenue streams to offset some of the quiet times in their business model, which we are experiencing today. So I think, these guys are incredibly well positioned. And for me to go and find 100,000 customers in Asia would take me a long time to replicate.
Yep.
So we're not looking to do that. We want to coexist and partner.
No, thank you. And hopefully by the next Shift Forex conference in Shanghai, we're talking about where volatility has jumped off the map here. So thank you very much for your time today, guys. Are there any other questions? We have one in the front here. Can you get a microphone, please?
I'm pretty loud.
Oh, there you go. Thank you.
Is that okay?
That's perfect.
Okay. Emil, you're the oldest guy there, other than me in the room.
I object.
Where do you see the biggest risk is right now in the FX? And what is the event, or what do you think about that can really affect our business today, the FX business? I'm not looking for a black swan event, but what do you think about? What keeps you up at night?
Regulatory issues. It's that simple.
The way I see it,
That's the answer. The black swan events, I think the industry has proven over years that we can manage these events quite well. I think the outside forces, which we have no control over, are regulatory events, and you've already seen how the U.S. regulatory environment has shrunken the industry from 25, 26 players down to 3 or 4.
So I think it's the uncertainty about the regulatory environment, particularly in Europe right now, is what I'm hearing from some customers. They're concerned. They don't really understand what the landscape's going to look like, and that must keep a lot of people awake at night.
The unfortunate thing about the retail FX industry, it's a small industry, so it doesn't have a big voice, and so it can be picked on quite easily by certain entities without those entities having any power to reverse decisions being made that influence their livelihood. But that's the biggest risk.
Do you think that there's a difference in the listed and the OTC? Do you think that when is
That's something you should ask Phil, actually, since he's on the listed side. I've been in the OTC markets for a long time, and I've always felt they're far more efficient than the exchange markets. You can get bigger volumes done without moving markets. There's more anonymity. There's more, and the price discrepancy, price transparency arguments to me are false. If you look at all the retail brokers, we're all basically aggregators. We aggregate 11, 12, 13, 20, 25 liquidity providers all the time, 5.5 days a week. It's fantastic what goes on there.
Here, here.
And to pretend that the exchanges give you better price transparency is a story. That's all it is. It's similar, but it's not different. So I think what we'll see here is we have to manage the regulatory environment as best we can, which is very difficult. The exchanges coming on as Phil is a great thing for the market because it gives it more credibility, for lack of a better word, to do. And the exchange markets, the over-the-counter markets should expand through this process, and the exchange markets should do well. But the biggest event problem we have is probably regulatory, since the regulators don't really understand the OTC markets. We see that through Dodd-Frank. We see that through a massive regulation that comes out through all sorts of venues, whether it's the fixed income markets, the currency markets as we're in, the derivative markets. It's just people that don't know about the markets regulating those markets. And it becomes very difficult to navigate through that process.
I think we have one more question in the front here. And
Quick question. You talk about how you're seeing more advanced kind of traders. You talk about how you're seeing a little bit more advanced customer base and talking about execution. I mean, are they still paying the spread and just kind of getting used to tighter spreads? Or are you seeing customers actually providing liquidity and really kind of concentrating on how they're placing their orders?
A little bit of both. I think it's a little bit of both. I think some of the way I see it, at least, is retail traders go through an evolution. So they come in and they're trying to understand, and as they get to be more sophisticated, they develop their own trading strategies in their style. So some of them have developed a strategy that requires very tight spreads, and they negotiate with brokers. They're like, look, it's essentially a bespoke conversation, right? Like, I'm going to give you a certain amount of volumes, and I need a very tight spreads for my strategy to work for me. And there are others who sort of develop strategies that maybe aren't high volume trading, but they're more based around certain events or certain news cycles and things like that. So that way they aren't as spread sensitive, and so they're looking more for how to beat the market as opposed to trying to say, and they're looking for more predictable spreads as opposed to, so the worst thing that I see, at least with the experience of the pro traders, their ask is, don't give me variability in pricing. Give me sort of a steady pricing, and then I'll deal with it.
Yeah, but I think there's more to it. I mean, if you're long US tech stocks in your 401k plan, and Russia blows up or something horrible happens in Iran or Iraq, those stocks, they haven't gone down, and no one really knows why stocks are so high, but we'll not have that debate here. You look for diversification, right? So you want to perhaps have some commodity exposure, some FX exposure that would be a risk-adjusted trade to offset potential losses that you have in your equity long position. And so these are the kind of conversations that we have at NASDAQ with these customers, and we do seminars with 500 people, 1,000 people that want to know, what can I do to insulate my long equity portfolio in times of trouble, uncertainty, volatility. And so they look at these markets, and the FX market is the purest market to express that kind of global macro position. What happens if something bad happens in that part of the world? I can express that trade in the FX market. So we find that as a very interesting kind of migration of customers, and the US is the biggest untapped market for that. You get in a cab in London or Moscow or Frankfurt, every cab driver is going to know the exchange rate. They're going to complain if you give them a foreign currency. They're going to know the exchange. You know this because you travel the world too, right? You get in a cab in San Francisco or Chicago, you give them money, they've got no idea what even the relative value of the dollar is abroad. So this kind of conscious understanding of the value of money and how it pertains to their assets is changing.
That goes back to where I thought the growth is happening, right? Like, if you talk to most investors and ask them how much, and I'm talking about equities investors, and talk to them and ask them, how much FX exposure do you think you have? They'll have no idea. And that is changing how you think about FX, how you think about, and it's changing from a traditional group of customers that we have had. So 10 years back, Oanda probably used to have day traders in FX, and now it's about educating and bringing awareness about what role FX can play in your portfolio to a broader group of population. Exciting
Actually,
times from that perspective.
That's where Phil's product works very well with institutional investors. They really can't play in our space because they're not regulated enough, or we don't fit the credentials they need in Phil's space, actually fills that void up, and we'll see some of that flow come back through us.
That's the plan.
Excellent. Any other questions? We have time for one more, or one more? Okay, here we go.
Just looking down the road, at what point would these low levels of volatility present a serious problem for even some of the biggest players?
Great question.
I have no idea.
Yeah.
6 months or less. It's going to get ugly soon. I mean, we can't go another year like this for a lot of guys.
I think it's the lowest level of volatility we've ever seen historically.
Yeah, April, May was what? Lowest in like 20 years, two of the lowest months in 20 years.
And mind you, it's all central bank manipulated. That's what's going on. So when they lose their appetite for manipulating it, or something so big comes along that they can't hold it anymore, that's when they'll stop. But we don't know when that's going to happen.
Excellent. Well, thank you for your time, guys. Appreciate it.
Thank you.